Good morning. We will pay attention to the periodic inventory system today and what the recording will be when we have an inventory loss. First of all, if we use the periodic inventory system, we will open a ledger account for every expense that you pay when you buy the goods. So you will have a purchaser's account for the purchase price of the goods. You will have a carriage on purchases account for the expenses that you pay to get the goods to your premises, and you will have an import duties account to pay for the import if you purchase the goods from an overseas country. All these expenses will form part of the cost price of the goods. So all expenses that you pay to get the goods into the condition that you want to sell it and at the location will form part of the cost price of the goods. Therefore, if we purchase goods, the purchase price, all expenses from the time that you purchase it until it's delivered to your premises, and any expenses that you have when it's delivered to your premises to get it in a condition to be able to sell it, will form part of the cost price. The value of inventory on hand can only be determined according to a physical inventory count. So because we don't use an inventory account during the year, we can't balance the inventory account to determine how much is the value of the inventory on hand. So it is important to know what is the value of inventory on hand, and you can only do that if you do a physical inventory count in the periodic system. Inventory shortages can only be traced if you know what is the gross profit percentage. So if we know what is the gross profit percentage, we can take our sales price, work out the percentage, and determine what our cost of sales should be. If we know what our cost of sales would be, then we can determine if the closing inventory is correct. Because if this cost of sales is not correct according to the gross profit percentage, it means that some of the inventory was stolen or broken. No entry will, however, be recorded for an inventory shortage, as it will be absorbed in the cost of sales because the closing inventory is lower. When your closing inventory is lower, the cost of sales will automatically increase. If we look at the information that was obtained from Michelle Dealers, we can complete an income statement and determine what is the cost of sales. So I will use my sales price and show that the total sales price is 42,000. My opening inventory was 6,000. My total purchases is 48,000. And my closing inventory is 28. So if I add the 48,000 and the 6,000 together, it gives me the total amount that was available for sales. Then I subtract the 28,500 that was not sold to determine what is the cost of sales figure. And if we have the cost of sales figure, we can determine what is the gross profit. Now, if we say that there is an inventory deficit of 6,000 because of a fire or inventory that was stolen, the closing inventories will reduce. Now the closing inventories will not be 28,500, it will only be 22,500. This will be the value of your closing inventory then when you do an inventory count at the end of the year. And I'm going to show to you now how this loss of inventory will automatically be absorbed by the cost of sales so that you don't have to record an inventory loss when you use the periodic inventory system. My sales are still the same, the purchases and the opening inventory is the same, but in the previous example, the closing inventory was 28,500. Because there were goods lost, it means that my closing inventory is now 22,500. If I take the 6 plus 48 minus the 22,500, 28,500, then my cost of sales is 31,500. So if you compare these two figures with each other, you can see that because the closing inventory decreased from 28,500 to 22,500, my cost of sales automatically changed from 25,500 to 31,500. So that means if I look at these figures, I can see that I have an automatic increase in my cost of sales from the 25,500 to the 31,500 because my closing inventory decreased from 28,500 to 22,500. Therefore, when we use the periodic inventory system, we will not record any losses of inventory because the closing inventory that is determined by inventory count will automatically be lower if there's things lost, and because it's lower, the cost of sales price will increase.